Hello and welcome back. This is the Real Estate Regroup Show, and I am your host, LJ Walker. Today, we're going to talk about a couple who divorces, and the one that gets the home can't afford to pay the mortgage anymore. You see, before, when they were married and they were living together, there were two incomes. Now, there's only one. So the solutions I'm going to give, mind you, is mainly for those of us who live in the United States. Some of you who live in other countries, you might be able to implement some of the solutions, but your financial infrastructure might be different, so you might not have the same opportunities as those of us who are here. Okay, so let's get started. As many of you know, when a person or person's couple gets a divorce, it's normally a financial strain. And it is viable that there might be an inability to afford to pay the mortgage after the divorce because there's a financial burden that comes up, right? There are legal implications. The terms of the divorce decree normally dictates who will be responsible for the mortgage. Now, sometimes alimony is given or is instructed. Sometimes it's not. And even when it is instructed, sometimes the other party does not pay what they are supposed to pay. They either don't pay the alimony, or if there's children involved, they may not pay the child support, or they may not pay on time, which causes a financial burden to the other party. Okay, so what are a number of things that can be done if you are the one that has the house, but you realize, hey, I can't afford to do this on my own by myself. Okay, so one of the things that you can do is you can negotiate with the lender. And there's many different things that the lender can do for you depending on who the lender is. Okay, and also what programs or what products and services that particular lender has to offer. For example, one of the things that they can do is they can reduce your interest rate or extend the term. They can also reduce your mortgage payment. It's called a loan modification. Sometimes they may want to see, the divorce decree. Not all of them, but, some of them do. But if you go to them and say, hey, I need a loan modification because this is what's happening to me, they may go ahead and do so if you qualify. Okay. Another thing that you can do is you can find a co-signer. If you have another reliable individual, such as your parents or your siblings, that has good credit to secure a new loan with you. That's another option that you can do. Okay. And then yet, of course, another option would be to get either another job that pays more money or get an additional job that puts a little bit more income in your account, or take whatever you have, if at all possible, and invest it in, I would say, the stock market, something liquid. Or if you are going to do real estate or thinking about doing real estate, you could do private lending, because with private lending, you can do like 3 months, 6 months term and make more money than if you were to just have your money just sitting in a regular savings account, bank account. That's another alternative. It might possibly be, depending on your dynamics. Okay. And then, of course, you can look into whether or not selling the home would be a wise decision. And downsizing to either a smaller property or a property that you can afford. All right. The other thing, of course, you can do is if the home is huge, you might want to think about renting part of that home to someone. But of course, whoever you rent it to, you want to make sure you do proper due diligence to make sure that that new tenant will pay on time and will not disrupt your life too much, right? You don't want any more headaches. You just went through a divorce, so you don't get so desperate that you just choose anybody, even if they do qualify financially. You want to just, find out a little bit more about the person to see if you guys will get along. Especially if you're going to be sharing the same roof. Okay. And then another thing that you can look into is you can seek legal advice. Some places, they have something called hardship foreclosure. You have to demonstrate financial hardship to the lender, of course, in order to qualify for that. Okay. Next, you have something called deed in lieu. This way, you avoid foreclosure, but the only thing is it might have a negative impact on your credit score. So that's why you got to really, really think about it. And there are places, honestly, where you can get free financial advice. Here in New York, we have financial empowerment zones. That's one place. And then you also have the New York Public Library, where they have free financial planners there. There's also online, I ran across something called Green Path, and they can direct you to places and people that can help you out for free. But like everything, when it's free, it's not always as comprehensive as if you pay. I also understand some jobs, like my job recently, they do have counselors, like they do have retirement counselors and things like that come to the job physically every once in a while, normally quarterly. And then you can also set up an appointment and either speak to them over the phone or visit them in their office. Okay, so that is an alternative that can be done. And then, of course, if your lender is let's say they are on the secondary market, which is me, what I do, and they are people who basically just bought the mortgage note from the bank or from someone who got from a flipper or what have you, who got the mortgage note from them. There are some people who, what they will do is they will agree to pay certain things for you. For example, they'll take care of the taxes as well as do a loan modification. But the gist is that if they're going to pay the taxes and do the loan modification and anything else, because those on the secondary market, we're a lot more flexible than a lot of these bigger banks. But if they agree to that, typically they're going to want equity in that home. So what that means is if you were to sell that house at any time, you would have to give a portion of whatever money you made on that sale. You would have to give it to that lender, a larger portion than normal, if you did not pay off the loan, if you did not pay off the mortgage. So those are the solutions that I can think of at the moment. For those of you who find yourself with a home that unfortunately you can't afford anymore, and you're thinking about ways in which you can either stay in the home or just keep your head above water, rather, really, when it comes to home ownership. Okay, guys, so that's all I have for you. Hopefully, the information that I've shared will help you make smart financial moves. Feel free to pass this amongst your friends. Remember, each one, reach one, teach one. Bye for now. Until next time, have a good night.